New home sales fell again to the lowest level of the year for June as high mortgage rates and affordability continue scaring off buyers. Despite a massive rally in the space, the builders are under pressure today. As you can see, a lot of red there, although small declines. Meantime, the June inventory of new homes was at its highest level since 2008. But one of the street's top housing analysts says there's nothing to worry about. The concerns are overblown. Good time to check in with Stephen Kim. He's Evercore ISI's Homebuilder analyst. Stephen, it's great to have you back. Welcome.
Thanks very much. Thanks for having me.
So, I'm going to ask you the same question I asked you a year ago, and you were completely right then. And I'm going to ask the same question now. And how can the rally keep going and how?
Well, I think, first of all, you have to start with analyzing the housing market. And then you secondly look at how the home building stocks are valued. And frankly, I see opportunity to sort of shed light in both areas. I think that when it relates to the housing market itself, there's been a lot of, I think, confusion around what is the reason why home prices have actually held in and actually moved up significantly since the pandemic. And a lot of people think that, and I heard actually a little bit of this, I think, on your prior segment, that maybe it's because it's because people don't want to move, and so there's no inventory of homes on the market. And right. I think that really is a misrepresentation. What's actually been happening is that after the GFC in 2008, we went through a 15-year period where we did not build enough houses. Mm-hmm. That was a 15-year period and left its mark. We just simply do not have enough homes in this country. And that is the reason why, even when you've had various demand shocks, you have not seen prices for homes come down because you don't have enough houses. And when you have a scarcity of something, it really inoculates you against some of the demand pressures that we've seen.
And to be clear,
the second thing
I was just going to say on that, Stephen, you're exactly right. There's no doubt that the fundamental thing that's happened is that all the millennials left cities and wanted to buy a home. There's more millennials. There's not a lot of new housing supply. There's a massive mismatch. I just mean at the margin. So I'd put you in the Steve Leisman camp. But at the margin, don't you think it would help if rates came down? I hear people all the time who want to move. They might have a little bit of maybe they didn't buy the best house when they had to scramble a couple of years ago. And they'd say, I'd love to do something, but I can't take on a mortgage right now.
One of the biggest areas of confusion, I think, is that people conflate a home for sale with a vacancy. So if you see people decide they want to move and list their house, there will be more houses on the market for sale. But will there be more vacancies? No, you have somebody living there already, and they're looking to buy something else.
Maybe an apartment,
so there may be a house for sale,
home.
But there's also one more buyer.
There's more multifamily.
And there's no increased vacancy.
That's where I do see maybe the boomer, that age demographic, maybe leaving a home and going into something smaller. I do notice that shift creating some opportunities.
Yeah, I definitely think the builders have adjusted to the inaffordability, which is a real problem, obviously, for a lot of incremental buyers. And so the builders are doing what they can to build smaller houses, to be more efficient with the space, doing more attached product and things of that nature. And that is all very sensible. And people are buying what they need. We are gone are the days when you're buying what you would like. You're buying what you need. And millennials, frankly, have delayed forming households, having kids, even getting married, and certainly, therefore, buying houses. So today's first-time buyers are older than first-time buyers in the past, which means they have more income, they have better credit histories, and they also have more urgency. And so they are less likely to be scared away by inaffordability issues. If they actually can pull together the down payment and have the monthly payment, they're really going to buy because they've already delayed for so long.
And I want to highlight tactically what you would recommend here. You have a great report from March people can ask you about, but the large cap home builders, Lennar, Pulte, D.R. Horton, and Toll, you think they're on the road to higher valuations, even with the rally that we've seen, that they're still you could argue cheap and heading, would you say 50% higher from here quickly?
I think over the next few years, you will see a revaluation to at least 50% higher valuations, and I believe earnings will be higher as well. So they could even do better than that. I would have people look at what happened to the largest stock in our sector last week, earlier this, I can't even remember what day it is anymore, but after earnings, it rose 10%. That was last week. And that was after CPI had already come in very benign and pushed the stocks up. Why did D.R. Horton move up so much on that day? It was because they gave two pieces of guidance that builders don't usually talk about: cash flow and share repurchases. And for the revaluation thesis, for people who are looking at these group of stocks like, hey, these are different kinds of companies with sustainable cash flow, that was music to the ears. And that's why I think D.R. Horton was up 10% in a day after you had already had the group move because of benign CPI.
And that is why we check in with you. Steve and Kim, thanks for your time today. Great to hear your take. Cash flow.